Let's say you're 60 years old and you've got $1 million across all of your retirement accounts. Now comes the big question. How much income can you safely and sustainably take from your portfolio in retirement? I'm Cary Green, financial advisor and co-founder of Green Era Financial, and I help people close to or in retirement to get the most out of life with their money. And today we're talking about withdrawals, what you can actually pull from your portfolio and spend in retirement. We're going to cover several real-world strategies, tax considerations, and an example scenario so you can walk away with real clarity. The 4.7% rule is the most commonly used method. The way it works in simple terms is you withdraw 4.7% of your portfolio in the first year of retirement, and then adjust your withdrawals for inflation each year starting in year 2 and every year after that. So, for example, maybe 4.7% of your $1 million portfolio in year 1 is $47,000. Then beginning of year 2, you check inflation, and this came out at 3% for the year. Now you take your $47,000 and adjust it up by 3%, equaling about $48,410 in year 2, and so on. Now, this used to be called the 4% rule, but the financial advisor who first popularized this guideline in 1994 recently updated his findings to now be the 4.7% rule. This strategy supposes that you should have a high probability of not running out of money over 30 years. Okay, now let's discuss the pros and cons of this strategy. It's extremely simple to implement, and it's based on historical research, the Trinity study, for example, and it's reasonably conservative for most retirees. But this strategy doesn't adapt to market conditions and can be too conservative for flexible retirees or too aggressive if you need to retire early. It also assumes a 50-50 stock-bond mix, which isn't what most retirees have, and it doesn't consider things like taxes or what allocation of funds you have in the various types of accounts. Now, this is a pretty simple to implement strategy, but it may not be the best fit, so let's look at the next option. The next strategy is the guardrails approach. This method sets a target withdrawal rate with guardrails. If your portfolio grows, you give yourself a raise. If it shrinks, you cut back slightly. So here's a hypothetical example of how this works. Let's say your initial withdrawal is 5% of your portfolio. You don't increase that withdrawal unless the portfolio grows by 20% or more. And then you reduce your withdrawal if it drops by 20%, as an example. Now, this is not a real-world suggestion of how to implement this strategy, but I wanted to paint a picture of how it works. So let's go over the pros and cons for this one. This is easily the most adaptive strategy, and it optimizes spending while protecting portfolio longevity. But it's far more complex to track and apply and requires discipline to stick to it. It's still a good strategy for retirees who want a balance between stability and flexibility, but it still may not be the best. So let's look at the last option. The final strategy is called the income buckets approach. Now, this can be a great strategy to apply to your income and investments in retirement because it helps provide peace of mind during market downturns and helps match your assets to your spending timelines. So here's how it works. Bucket number 1 is generally for the next 2 years and usually contains cash or cash-like alternatives. Bucket number 2 is for years 3 through 10 and usually utilizes bonds or income-generating, fairly conservative investments. And bucket number 3 is for longer than 10 years, and this is where you utilize stocks or growth assets. Now, the way this works is you withdraw your income each year from bucket number 1, and then periodically refill bucket number 1 from the other 2 buckets. So, what are the pros and cons to this bucket strategy? Well, it helps provide peace of mind during market downturns and volatility, and it matches assets to your spending timelines. But it requires maintenance and discipline, and it may be inefficient if buckets aren't periodically rebalanced. Now, to implement this strategy, you determine how much you need in each bucket based on expected spending, and then invest accordingly. This is a great strategy, and it's gaining in popularity for retirees because it takes a lot of volatility out of the mix. Now, there's a comment I often see on the internet and here on this platform of, why not just put your money in index funds earning 8 to 10% per year and live off of that? And this is a really good question and it's worth addressing. The truth is that you totally can do this, but there are going to be some pitfalls that you have to be aware of and some risks you have to be willing to take. For example, though many market-based index funds have average returns in these ranges over time, these returns are not linear, and they're based off of long periods of time. In down years, there are no gains to withdraw. And in volatile years, you may not even know what your gains are until the end of the year, making the timing of withdrawals and your income in retirement very tricky. So for example, if you retire at 60 with $1 million and you plan to take 8% out of your portfolio in that very first year, but then the market drops by 20%, your account could go down from $1 million to $720,000. And now in year 2, you have a much smaller nest egg to pull from. This could cause you to lose as much as a decade in how long your funds will last you over your retirement. This is called sequence of returns risk. It's one of the biggest risks retirees face in the first few years of retirement. So this withdraw the gain strategy doesn't plan for bad markets, inflation spikes, or unexpected spending shocks, and makes pulling predictable income out of your portfolio in retirement very uncertain. Okay, now let's look at how the different types of accounts impact the withdrawal strategy. So let's say your $1 million is split like this. You have $700,000 in pre-tax accounts like traditional IRAs or 401ks. You have $200,000 in Roth accounts, and you have maybe $100,000 in a taxable brokerage account. This matters because not all withdrawals are taxed equally. Traditional IRA and 401k withdrawals are taxed as ordinary income, the highest tax rate. Roth IRA or Roth 401k withdrawals are totally tax-free if they're qualified. And brokerage accounts are taxed on the realized capital gains and dividends. So if you withdraw $47,000 per year from just your traditional IRA, you might owe anywhere from $5,000 to $10,000 in federal taxes, depending on other income streams and your deductions. But blending withdrawals from taxable and Roth accounts can help reduce your tax bill and stretch your dollars further. So here's a common sequence for withdrawing funds in retirement. 1, taxable brokerage accounts first. 2, then traditional pre-tax accounts as needed. And 3, let your Roth accounts grow for as long as you can. Or maybe you blend these withdrawals strategically to stay in your tax bracket. Now, this sequence may not be right for you, but it's just generally the most common approach for tax reasons, and I wanted to give it to you as an example. Now, if you're planning on retiring at 60, you won't be eligible for Social Security until you reach age 62 and a half, and you'll get even more the longer you wait to claim it. So delaying until age 67 or even 70 can boost your benefit substantially, especially if you don't need the income right away. So ideally, your portfolio needs to carry you for those first 5 to 10 years. And this is often the most vulnerable part of a retirement. We call it the retirement red zone. But this is where planning becomes crucial. Let's say you're 60 with $1 million and you plan to withdraw $45,000 from your portfolio starting right away. And maybe you also want to delay Social Security until age 67, expecting at that time you'll get $42,000 a year then. From age 60 to 67, your portfolio does all the heavy lifting. Using a blended withdrawal strategy, maybe you draw $15,000 from taxable accounts, $20,000 from pre-tax accounts, and $10,000 from Roth accounts. Your effective tax rate might be around that 8 to 10% level, leaving about $41,000 to $42,000 in spending money. And then once Social Security kicks in at age 67, you can lower your portfolio withdrawals or reallocate to extend the longevity of your portfolio. Now, there's a saying that's also relevant here. No plan survives contact with the enemy. No strategy works if it's rigid. It's important to build in flexibility. So consider these tips to help you out. Spend less in bad years. Avoid panic selling in volatile markets. And use Roth funds to fill gaps in high tax years. And reassess your plan annually. With a thoughtful plan and a little flexibility, your $1 million can absolutely support a confident, lasting retirement. So if you're 60 with $1 million and you're wondering how much can you safely withdraw, there's no one-size-fits-all answer. But using strategies like the 4.7% rule, guardrails, or income buckets, and tax-efficient withdrawals, you might start in the $40,000 to $50,000 range and adjust from there. And if you want help building a withdrawal strategy that fits your lifestyle, visit us at greenerafinancial.com or feel free to reach out to me at any time. I'm always happy to help if I can. Thanks for watching, and I'll see you next time.